We started this holiday shortened week with another tough day on Wall Street. In fact, for the NASDAQ composite, this is the 7th sell-off in a row. That hasn't happened since 2016. Not only that, but the selling has been so consistent in recent weeks that we have clusters across the board on all 4 of our US equity indices. We'll spend a lot of time in tonight's video talking about that. And then I wanted to talk about bonds and yields and interest rates fresh off of my trip to Jackson Hole over the weekend. Didn't see any remnants of Jerome Powell there. Nonetheless, I had yields on my mind, and that's where our focus was in tonight's trade application example, hoping for a snapback rally in the bond market now that we've got cluster signals in the dailies, the weeklies, and the monthly charts. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's September 6th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area. Make sure you're signed up for our email distribution list so that way you can be notified whenever we post these videos. We'll also let you know which stocks are giving you overbought and oversold cluster signals at the bottom of those emails. And I'd imagine that tonight there's going to be a whole pile of oversold cluster signals given what's happening with the indices. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me. My handle is @BrandonVanZee. We really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group that you see in that web address in the logo in front of you. Let's go ahead and jump into today's trading activity. And as we kick off this holiday shortened week, of course, here in the United States, we had Labor Day yesterday. Hope many of you enjoyed your weekends. I certainly enjoyed the fresh mountain air of the Jackson Hole area. Didn't see any remnants of any discarded Jerome Powell speech notes or anything like that I can share with you, but it certainly saw some very impressive granite peaks of the Grand Tetons. Whatever it was that you did, hopefully you got a chance to unplug from the markets a bit. But as we kick things off here this morning, we saw that there was quite a bit of volatility as we saw both up and down action, depending upon the index, up and down as much as 1% on either direction before kind of settling into things here for the day. We did end up having mostly a down session by the time it was all said and done, and the NASDAQ itself has been in quite the slide. The NASDAQ composite is now down 7 days in a row, and that hasn't happened since 2016. So this is no run-of-the-mill pullback that we've been experiencing here lately. It has been a legitimately painful experience, and for those of you that listened to Jerome Powell there in Jackson Hole a couple of weeks ago, he used that term specifically, expect pain, and I guess he kept his promises, because that's exactly what the market's been feeling here more recently. So let's take a jump into today's heat map here. And as you can see, the vast majority of stocks did close in the red. However, it wasn't a complete shutout. There were some major companies that did manage to close in the green, including Tesla, which was up 1.5%. We had some nice rallying out of a lot of the healthcare stocks. Johnson & Johnson, Eli Lilly, United Healthcare, Pfizer, Merck, AbbVie. All those did close higher here today, as did Bristol Myers and Danaher and Thermo Fisher. We also had a big deal announced in the healthcare space today with CVS buying a home health company. It did close a little bit lower on that news, but just a reminder that when markets get a little bit chaotic and prices get volatile, certain businesses will look to kind of buy the dip as well. In the case of Signify, the company they were buying, it wasn't much of a dip, but nonetheless, even other companies are going to be looking to acquire their competitors if prices get too out of hand in one direction or another. Other areas that did manage to close in the green today, I would definitely point out real estate. That actually happened to be the focus sector for my dividend growth investing class here today. Now remember, when you're evaluating real estate investment trusts from a long-term perspective, you're going to want to use things like funds from operations per share as opposed to typical earnings per share that you might use with stocks from the 10 other sectors out there. So if you need some assistance with understanding that a little bit better and you're a premium member of Market Scholars, that class has now been posted. You're welcome to check out that recording if you missed it live. But from a trading perspective here, in the ultra short term, real estate did seem to have quite a strong day here. Most of them closed in the green. We also had a little bit of a patch up here in the financials that managed to close in the green. It wasn't overwhelming by any means, but at least it wasn't a complete shutout. We also had a little patch down below here, kind of in the industrials area, that managed to close in the green. But for the most part, I think what our eyes generally see when we look at this heat map is a lot more red than green. And importantly, some of the bigger players out there like Amazon, Google, Microsoft, and Apple all did manage to close in the red here today. Remember, Apple has an important day tomorrow. I think tomorrow's their iPhone 14 release extravaganza, and so who knows, maybe there will be an opportunity for some more volatility in its shares price tomorrow. But yeah, all in all, looked like it was more of a down day than an up day. Let's go ahead and take a look at the specific breadth numbers now. And now I'm back on over here on the visualize area of the Market Watch tab. I've got the S&P 500 pulled up, and as you can see, there were 188 out of the 500 stocks that closed higher here today. So that's about a 37% hit rate for the positive performers, and another example of now recognizing that there were way more losers than winners here within the market today. Let's now start talking about our 4 grid. And so coming on over here to chart 4B, for those of you that are premium members following along at home. I did get a question over the weekend from somebody who was inquiring about our services and wondering if they needed to be a Thinkorswim customer or a TD Ameritrade customer to be able to have a Thinkorswim platform account. And while David and I don't work for TD Ameritrade anymore, we used to, of course, a long time ago, but now we just use their products and services as the owners of a completely separate business of Market Scholars. The way that it works, at least the way that it used to work, and to my knowledge still works, is that as long as you sign up for a TD Ameritrade account and basically get a username from TD Ameritrade, you can then use that username to log into a Thinkorswim platform for free. And note that you didn't hear me say that you needed to fund the TD Ameritrade account. This particular person that was asking me a question had some constraints because they worked in the financial industry, and their business required them to trade through different brokers, not TD Ameritrade. So that was that particular situation. So whether it's because you've got compliance restrictions or whether you're just completely happy with your current broker and you don't want to transfer any money over to TD Ameritrade, but you still like the idea of being able to use a Thinkorswim charts, that's something that you can explore. Again, you might need to check with them on the specific details, but from my knowledge, you can sign up for a TD Ameritrade account, never fund it. They don't charge you any sort of fees to do that. There is no, minimum holdings or anything along those lines, the last I checked, and therefore, as long as you have a username for TD Ameritrade, you can then use their paper money side of Thinkorswim platform completely for free. So something to think about out there. Might not be perfect for all of you depending upon your situation, but in case you were curious about that in the past, just thought I would mention that since it's fresh on my mind here after responding to that email. Anyway, back to these charts here. Remember, David and I provide these 50 plus different charts as part of our package that we offer our 3-year premium members at Market Scholars. It's a little bit of a fringe benefit. Of course, the core of what we offer you in the premium space is the 10 different classes that we teach you each week, each with their own kind of trading plans and different approaches and strategies towards the market. But for those of you that are already premium members, this is chart 4B. And as you can see, I've got the S&P 500 pulled up in the upper left. I've got the Dow Jones Industrial Average in the upper right. I've got the NASDAQ Composite in the lower left. And I've got the Russell 2000 in the lower right. And for those of you that are perceptive, you probably have already pointed out something or picked something out with your eye that I'll just give away for the rest of you right now, which is today was a bit of a unique day because we had clusters across the board. All 4 of our charts, as you can see, have this little green dot that are showing up underneath the candle of all 4 of those major US indices. They also correspond with these little green dots that you see in the market forecast indicator down below as well. So they show up in both places just to make it easier for your eyes to catch them. But what they signify is that we have what's known as an oversold cluster signal using the daily candle charts on all 4 of these charts. And how you get that signal is to have all 3 of the colored lines on the market forecast close in the lower reversal zone on the same day. So let me right click on the S&P 500 and maximize this cell here so you can see it a little bit better. Notice down below here in the lower right hand corner, that blue near-term line, that red momentum line, and that green intermediate line are all below 20 on the same day. 20 is the start of the low reversal zone on the market forecast indicator. And not that that is anything magical or anything along those lines, but what it does effectively tell you is that things have gotten a little bit too one-sided, or at least that's the way I tend to think of these cluster signals, especially when they are more consistent and on big US indices like this, as opposed to a very specific one-off individual stock or perhaps one-off type of asset class like Bitcoin or something like that. You guys have heard me use the phrase "the boy who cried wolf" a lot of times in the past. I do not think of the S&P 500 that way. Now, just because it hasn't been that way in the past doesn't guarantee it can't become that way in the future. But as just one example right now, you will notice that on this 3-month chart that we're looking at here for the S&P 500, there has only been one other time that we've had an oversold cluster signal, and it happened to be the day that set the low of 2022 so far. So whether that low gets taken out later this year, we'll all see. But it does kind of prove that point that on this day here, June 17th, again, notice that there was a blue, red, and green line all below 20 on the same day, plotting that little green dot. You can't really see it up here on the chart because I also have this low tag on there, and the low tag kind of covers up the green dot, but it's back there, it's just hidden. But the point is, notice that tremendous fall the stock market had in the couple weeks leading up to that oversold cluster. Then compare that to what we've been going through here in the last couple of weeks, and they're somewhat similar, somewhat reminiscent of one another. You can see this one was probably sharper back here in June. This one has probably lasted a little bit longer, the one that we're dealing with right now, but both of them have the commonality of they were pretty violent pullbacks in a short amount of time. You know, if you get like a drawing tool out here, and let's just do this one right here to give you, whoop, hang on. Let me go back real quick. Didn't mean to do that. There we go. And if I click once and then click down to the low, there's that little white box that kind of starts showing up there at the top that it says 11 days, so you can kind of see it above the candles up and to the left. It says that was about 9 bars is what that took, and it was a move of about 13%. That's a pretty strong move. And then we compare that to this move that we're currently on right now. If we take the tippy top of where we were at back there in August and kind of come down here to the lows of today, unfortunately it's being blocked, rats. I can't see exactly what it is, although I can see half of it. So I'll just read it to you. I know this is hard for some of you to see, but that's about a 10% move right there. So I can't see how many days that is, but obviously you can see it's more days, but slightly less in terms of actual percentage meltdown. But both of them were double digits, right? We are in the midst of a double-digit percentage move right now. While that may not sound like that big of a deal to some of you, remember it wasn't so long ago. Let me click off of these here real quick because I don't want them to stay on my chart. It wasn't so long ago. If we go back just, let's call it 3 years, and let's do a 3-year daily candle chart. Where are we at? There we go. It was during this time period right here in 2021, that was just last year, remember, it seems like forever ago, but it was literally just last calendar year, where we hardly had any pullbacks at all. Here was the start, what I'm circling right here, and here was the end right up here. So if I kind of just zoom in only on 2021, you'll be able to see that a little bit better. But as you can see, we really just had one legitimate pullback in the year 2021 that started here at the beginning of September and kind of bottomed there at the beginning of October. And if I were to use that same drawing tool to kind of measure that, you can see that that was only a 6% move right there, right? So we've just had two double-digit percentage moves in a very short amount of time in this calendar year, which we've still got 3 more months to go. And we didn't have anything even remotely close to one of them in the entire calendar year of last year. So if this has felt a little bit difficult here all of a sudden once again, I think you have every right to have those feelings, because it has been difficult. This has been a more aggressive pullback that we've witnessed here in just the last couple of weeks. And now that we see this oversold cluster signal showing up here, it's giving us maybe a ray of hope that we're due for some sort of a rally. Now, what we do with that rally remains to be seen. But I think the last time we had the oversold cluster provides at least some sort of a good reminder that when we have the reversion to the mean rally, so notice that it started happening the day of the cluster and started rallying for an entire week immediately thereafter. And that was a pretty big move, by the way, as well. And that's the other thing that you have to remind yourselves of. Sometimes you get beaten to a pulp like we have been here in the markets recently, that we forget that markets can respond to the opposite direction very quickly as well. In this particular case, in just 1 week's worth of time, we went up about 8% in just 7 days back there after that first cluster. So could that happen again? Well, it's possible. As I draw that particular line back there, and if I were to then activate this and move it to where we're at right now, just to give you an idea, I know that kind of goes off the chart there, but you'll see what I mean, that if we had that type of a move again, we could get back up here to about 4,200. And that was pretty much where this market failed. So that would be an interesting point where the bears could come in, start selling off the market again, and have some resistance right there. So we'll see what happens. But my impression, or my thought process whenever we have a violent move lower like this, is first of all, stocks don't go down in a straight line and they don't go up in a straight line. There are give backs and bounces along the way. We are overdue for a bounce back higher. I think that today's oversold cluster signal could be one of those excuses the market could have to rally it back the opposite direction. But my hesitation around getting too excited around something like that is knowing that a lot of those reversion to the mean moves then start struggling at the downtrending 30-day moving average. And it did it right there. It did it right there, and it even did it for one last day right there before finally getting enough momentum behind it to kind of push it up there towards multi-month highs. So my first expectation is that, yes, we will probably get some sort of a short-term bounce. If it comes up to this 30-day moving average and looks like it's going to start rolling over, I'm probably going to want to get a little bit less bullish, or perhaps put on more bearish trades at that point. And then if it ultimately breaks through there like it did that time before then, we can always change our mind, and we can always reposition portfolios and trades and things like that if necessary. But just wanted to share that with you to give you some sort of an expectation as to what we experienced last time, and to remind folks that we are due for some sort of a bounce here. And maybe this is the excuse that that market participants needed here, because it's not just the S&P 500. As I mentioned before, it's all 4 of our charts have these oversold cluster signals. And with the S&P 500, it had a prior example of that, as did the Dow Jones Industrial Average. As you can see, this candle right here that plotted this low was the day of the oversold cluster signal, on June 17th for the Dow as well, and it led to obviously a pretty epic rally in the couple of months after that. With the NASDAQ, we didn't even have an oversold cluster signal over there, and that was the same with the Russell 2000 as well. Now, it was very close, you just narrowly missed it, but we didn't actually plot an official oversold cluster signal there, at least on the daily candle charts. Remember, on the weekly candle charts, I was pointing that out to you on the NASDAQ over the summer because it was so unique that it was literally just the second time, and I think it was like 10 years or something like that, that you had one of those cluster signals on the weekly charts. But on the daily charts, it just narrowly missed having one back there. So again, it just kind of goes to prove the point that these are pretty rare signals. These are not just something that you see hitting every week or something like that. These are, once every so often types of signals, and the rarer the signal, the more impactful they can become if they show up, and they're showing up right here, right now. So let's brace ourselves for some sort of a snapback rally in the short term, whether it starts tomorrow or later this week or early next week. I have no idea there, but I would expect some sort of a bounce back here in the short term. So let's see if we can maybe do that heading into the September expiration for options into next week. Remember, that would be next Friday when that September expiration takes place. Now, naturally, when you have a cluster signal like we do on all four of our charts, that by default means that we have strongly bearish postures, right? You can't have a cluster signal without also having a strongly bearish posture, because they are one and the same in a lot of ways. The green line has to be in the lower reversal zone in order to have the cluster, and when the green line is in the lower reversal zone, we have the strongly bearish postures, which are identified by those background colors being dark pink. But remember, that's not anything new. What's new today is the clusters, but having a strongly bearish posture is not new. We've had that for the last week, and we've had weekly bearish postures for the last 2 weeks. So we've been in bearish mode for a while. It really, since we broke down below those 30-day moving averages, it became a lot more apparent at that moment. Notice that all of these moving averages are now red as well. That was not the case for the Russell 2000. As of Friday, it actually closed with a yellow moving average, but then reverted back to red once again here today. And that was the case the day before as well. So it kind of has gone back and forth, unlike the others that have kind of stayed red. But a reminder that the red moving average means that in this case, price is below a falling 30-day moving average on all four of these major U.S. equity indices. So you have to make the assumption that since these represent the markets at large, that most stocks within the market are going to look somewhat similar to this as well, and therefore we are in more bearish market conditions right now, where we're just not finding the stability that bulls would need in order to push the markets a lot higher. We also remind ourselves that September is traditionally a tougher month for the market. October can be as well. I don't think it's as consistently bad, but the bad Octobers are, the really, really bad months, meaning that they're not as consistently negative as September is, but it is where you happen to find some of the worst stock market crashes in history. So we've got that, boogeyman out there in the month of Halloween to haunt us here yet for another couple of months. And then, of course, we've got midterm elections coming up first week of November. And then we get into a seasonally stronger period of the year for the rest of November, December, and then into January. Traditionally, now not every year is going to follow the exact same roadmap, but just kind of mentioning that so that way you can tuck it away in the back of your mind and remind ourselves that markets don't go down every single day. It might feel like it because of what we've been dealing with here lately, but there will also be equally as bullish moves in the future, and it's important for you to stay rational, logical, have a cool head on your shoulders, do the best you can, knowing that we are trying to suffer through some difficult market conditions right now. To put a ribbon on it, S&P 500 was down 0.41% today. Dow Jones was down 0.55% today. NASDAQ Composite was down 0.74% today, and the Russell 2000 was down 0.96% today. Let's go ahead and pop on over here to the internet briefly. I always like to get a chance to say thank you to those of you that help support these presentations on Twitter and other social media. As I always say, as long as we're up and over 100 likes, the last time I did the video, I'll be more than happy to give you another full-length video, including a trade application example and all the 12 grid analysis and all that good stuff as well. So once again, you guys came through for me. Never doubted you for a second, but in all honesty, I do appreciate that. It goes a long way with both David and I. So please keep that up on your end if you do like having these free videos available to you as often as they are. Let's do some shout outs here, and let's say thank you to Stacy. Let's say thank you to Paul and to Dave and to William and Carl and Ken, David and Austin and Boss and Jayesh and Terry, John, Aviva, Damon, NZ, Eugene, Edward, Jay. We've got Fred, Robert, Ron, Karen, Norm, Ilan, Janet, G, Robert, we've got Brian, Violina, BZ Japan, and others. Can't get to all of you. There's just too many. I don't want to chew up too much of our precious time here, but I also do want to make sure I acknowledge that you guys are doing a wonderful job for us. We really appreciate that. Please keep that up. Let's also take a look here at another area of the internet. Now, this is back on the Market Scholars website. Remember, once a month, I do a couple of free posts on the dividend growth investing category under our blog. So if you hover over the blog area of our mega menu and click on dividend growth investing, or if you're already in the blog, let's say you're watching the Market Outlook video here or something, and you click this drop down for categories over here, that'll get you done as well. So anyway, feel free to check that out. There is a new post for dividend growth increases there from the month of August. We actually reviewed a lot of these in my dividend growth investing trading room today, so if you want to hear my thoughts on those and you're a premium member, feel free to watch the trading room itself. But otherwise, if you're not a premium member, you still have access to being able to check this out on your own on our website. I also spent some time in last Thursday's question and answer session talking about the dividend stair-step sector statistics, which is also available for free on our website. So feel free to check that out if you or any of your loved ones like the concept or the strategy of dividend growth investing. That could be a useful resource for you at least once a month there. Also, let's have a little chat here about the sector selector. This week, we did have one major thing to discuss, and that was technology took a pretty vicious tumble here. As you can see, technology now finds itself at the number 10 position, second to last all of a sudden. Remember, a month ago, they were number 1. So things have been quite volatile with technology. And remember, the way that I do the rankings on this particular tool here is on an equal weighted basis, not on a market cap weighted basis. And so Apple and Microsoft do not have as much control over what's happening to the technology sector here the way that they might under different approaches out there. This is equal weighted, meaning that all the companies that are in the tech sector in the S&P 500 have an equal chance of moving the rankings to one another, and gives us a more pure understanding as to how the whole sector is doing, as opposed to how are just one or two stocks going to be doing within that sector. And so the average tech stock has taken quite a tumble here recently. We saw that a little bit. Was it a week or so ago? I think it was like Okta and Zscaler and some of those, cloud computing and software names have really been getting blitzed here recently. So I'm sure that had an impact on the rankings here this week. So that was the major thing. Otherwise, not a tremendous amount of other movements. We still see energy up there at the top, of course. Not only are we dealing with tough energy situations here in the United States, but it's quite a bit worse over in Europe. From my understanding. And so oil prices are remaining, suspiciously high during that time. And if oil prices are high, then profits of the oil companies can be maybe a little bit stronger in that environment. And then communication services remains dead last at the bottom. All right, let's go ahead and now pop back on over to the main part of the platform. Let's do some 12 grid analysis now. Starting with chart 5A, this is our asset class 12 grid. And a reminder that the background colors will tell us what the posture of the underlying security is using the market forecast intermediate line. And when the background colors are green, that means the current intermediate posture is bullish. When the background colors are pink, that means our current intermediate posture is bearish. And let's start in the lower left-hand corner. I actually just got done tweeting about this not too long ago. Let me come back over to Twitter here real quick and show you what I tweeted. I just took a screenshot of this particular chart right here without actually showing the ticker symbol because I wanted to see how many of you were on top of it. And I'm sure most of you were because you you pay attention enough to know that this is a very important asset class here. And I said, I found a chart with a perfect trend. Rather than scouring your brokerage account to see if you own this hot security, check your wallet instead. And I probably should have been more specific about that and said, Americans, check your wallet instead, because I know we do have a lot of international viewers of this YouTube video as well. And you guys might be experiencing the exact opposite problem depending upon what country you reside in. But us here in the United States, we have a very strange problem, and that is the US dollar is almost too strong. And this happens to be UUP's chart here, by the way, which is an ETF that tracks the dollar versus a basket of other currencies, mostly against the euro. Nonetheless, it does give us a quick and easy way to judge whether the dollar has become stronger or weaker compared to other currencies out there. And as you can see, the dollar in this form is up 20% in the last year. So all else being equal, if you were to take a trip over to Europe today, you might be able to buy 20% more products and services than somebody who took a similar trip here just 1 year ago. And as you guys have heard me mention in this presentation many times in the past, I actually think that's a bad thing for the stock market. While it's a great thing for American travelers going overseas and spending their money on fun vacations, it's less fun when you're an American investor, because what it often means is that our biggest international and multinational companies that are oftentimes headquartered in the United States have a slight disadvantage. So think about companies like McDonald's and Coca-Cola that do business all over the globe. When those profits that they're making in those far-flung areas get converted back into dollars during the earnings announcement season, it's going to appear that they actually made less money than they did as a result of a weaker euro or other currency being translated back into the dollar. You also have the disadvantage of commodities usually struggling when the dollar is too strong, and that can impact a whole different group of publicly traded companies. So on the whole, I much prefer operating as a stock investor in a weak dollar environment, and that is the exact opposite of what we're dealing with right now, which probably proves the point, knowing what the stock market's gone through here recently as well. Remember, the US dollar can sometimes be viewed as a bit of a safe haven asset. When there's a lot of chaos out there, money can drift into the dollar and out of other perceived to be riskier asset classes like stocks and what have you. You'll also find that the dollar, when it's surging at a very aggressive rate, has the possibility of really upending foreign securities. And so note that EEM here today was down 1.19%, which was worse than all four of the key U.S. equity indices. Didn't really happen with EFA on the developed foreign side, but certainly with the emerging foreign stocks, they've tumbled pretty aggressively here as the U.S. dollar has been ramping higher. Note that EEM has been torpedoing lower. Notice here that EEM actually is at a 3-month closing low right now. It closed with its own oversold cluster signal, but notice the difference between that and the U.S. markets. Here we are, and here was the prior low. We're still quite a long ways away from that prior low, but if you're operating in the markets in China and India and Russia and Brazil and other emerging markets, you're at new lows right now. So, and that's part of the story behind that is the strength in the US dollar there. So it's been tough sledding there in some of those foreign markets. And although EFA slightly outperformed the US markets today, In the last few weeks, they have not. And they have the same problem here as EEM, where they're basically at 3-month lows right now on a closing price basis. And they've actually had 2 days in a row of oversold cluster signals there. Both of them currently have red moving averages as well. And remember, it was starting to look a little bit better for them, a month or so ago when they were starting to break above the moving averages, and how quickly that has been unwound. It's been pretty breathtaking, to say the least. The other chart, by the way, and before I get to that, remember that all else being equal, commodities can struggle when the dollar is too strong, since those commodities are priced in dollars, and that is what we saw today. Gold was down 0.58% today. Gold is basically at its own 3-month low, and then oil was down just fractionally, but nonetheless down just a touch, and is fairly close to its 3-month low. So as the dollar has gone up, lower left to upper right, notice that gold has gone from upper left to lower right, upper left to lower right, right? Starting high, going low, starting high, going low, because the dollar is starting low and going high. So, will that reverse course? Well, it remains to be seen. What we do know is that their trend is definitely in place for the US dollar. But what we also know is that things have maybe gotten a little bit too overheated. We do have one of those overbought cluster signals there on UUP, but that was last week, and so far it hasn't really seemed to slow the ascent. So I'm not sure it's going to. And obviously I'm not expecting the dollar to go up every single day. Could it come down to its rising 30-day moving average and catch support there? I think that's definitely a possibility. In fact, probably in the cards at some point. But the question is, can you actually have the US dollar spill over and go from being in an uptrend to being in a downtrend, which would then perhaps support the stock market at large, right? That's what a lot of us would like to see. And I'm not on the I'm not going to go on the record right now saying that that is a likelihood. I always try to keep an open mind and stay flexible in my thinking. So I'm not going to say it's impossible, but I'm just going to say that a trend is your friend until the end. And right now, the trend is clearly to the upside with the dollar. And so when we have these minor pullbacks, the assumption, unless proven otherwise, should be that those minor pullbacks in the US dollar will eventually be bought and will continue to bounce higher. So anyway, keep your eye on that possibility, but that seems to be one of the problem areas of the market right now. The US dollar just simply too strong, and it's not allowing a lot of those other riskier assets to catch any sort of bullish steam. Now on to the other chart in the lower right-hand corner in this case. This is the TNX, and similar to the US dollar, it's had a great run here recently. Now, TNX represents the 10-year U.S. Treasury yield. That is different than the dollar. Nonetheless, you will see that in many cases they do travel together. Remember, in order to access those higher yields, foreign investors have to liquidate their currencies, buy U.S. dollars, and then use those U.S. dollars to buy U.S. treasuries. So there can be certain moments in time where those two things are connected, and it does seem like that is the case right now. Again, back on over here to Twitter, I'm going to show you where our yields were over various time frames. And as you can see here, the 2-year Treasury note is at a 3.5% yield right now. That is higher than the 10-year Treasury note yield of 3.35%. So that is what's known as a 2s and 10s inverted yield curve. But all of these numbers are high compared to what we have been used to in really my, in most of my career, maybe not all of it, but most of my career, certainly the last 10 years, these are some of the highest numbers that we've seen along the way. So we do have ourselves a bit of a problem when it comes to too high of yields, which also means that the flip side of that is that bond prices get hit. Now, we'll spend a little bit more time on this when we talk about our trade application example a little bit later, but for right now, just know that TLT was down 2.5% today, has another oversold cluster signal. BNDX, which is a way to track foreign bonds, was down 0.67% today. It narrowly missed an oversold cluster signal. And then high yield bonds also closed lower today by 0.27%. They've held up a little bit better. You can see they're still well above their lows back here in June, whereas TLT, government bonds, are actually breaking to fresh multi-month lows. With rising rates comes falling bond prices. And we'll see if we need some sort of a reversion to the mean there with bonds here sooner rather than later. Another big talking point here today was Bitcoin. Bitcoin had a fairly large breakdown here today. Bitcoin fell over 5% today and is now trading below 19,000. Remember, it was holding on to 20,000 reasonably well. Then again, I think part of the reason that it was holding to 20,000 was because it didn't really bounce as much as you would have expected when the rest of the stock market was going up so dramatically in the month of July and into early August. So because it didn't go up as much, perhaps it didn't have as much to give back. But now all of a sudden, it's becoming a little bit more concerning because this was a pretty violent day here today. This was more than $1,000 give back in Bitcoin. And we are now at new multi-month, if not even year, lows here. You can see that where we closed today was lower than where we closed back here at the beginning of July on Bitcoin. So that's another way to kind of measure the risk appetite of the market. And it's not a bullish sign when you see Bitcoin hitting fresh multi-month lows. Even if you yourself don't care about Bitcoin, it is a way to judge the general market's risk appetite. And right now it's saying the market doesn't really have much of an appetite for risk. And that's not a great thing for the stock market either. Let's go ahead and take a look now at our sector 12 grid. This will be chart 5C for those of you following along at home. And as you can see here, we've got pink all the way across the board. Now, there are two of these charts that are light pink. So those two are energy and utilities. And what light pink means is those are weakly bearish. All the rest are considered strongly bearish charts. With those two light pink charts, I would say that they do kind of stand out to my eye as being better than the other charts that are on the board, slightly more bullish, mostly because they are still holding on to the 30-day moving average. In the case of energy, you're still above a rising moving average. In the case of utilities, you're basically sitting right on top of it right now. So as soon as tomorrow, you could have a bounce up and off of it. We'll just have to see. But those two are the only two that can make that claim. You look at the price versus the moving average on all the rest of the sectors out there, and they're all dramatically below it now. Some of them so dramatically below it that, of course, with the S&P 500 giving us an oversold cluster signal today, naturally there's going to be some sectors that will do the same thing because it's the sectors that make up the market. So in terms of which sectors fit the bill today from an oversold cluster perspective on a daily candle chart, there is communications with its first oversold cluster signal in over 3 months. There is technology with its first oversold cluster signal in over 3 months. There is Staples. However, Staples is a little bit different because they did have an oversold cluster signal back here in the middle of June. And you can see that it did fall for a couple of days after that, but then had a really nice reversion to the mean move immediately thereafter. So maybe that can be a template for what to expect coming up here, not just with the consumer staples, but as I mentioned, perhaps with the S&P 500 as well, where we're due for some sort of a short-term bounce back higher towards those moving averages. You'll notice that most of the moving averages on these various charts here are red with price below them. So really it's just energy and utilities hanging on with any semblance of bullishness. All the rest of the charts are bearish, and some of them so bad it could be good because it could represent a possibility of a dead cat bounce with all of those oversold cluster signals there. In terms of who were today's biggest movers in one direction or another, I had mentioned real estate looked consistently strong today, and you can see that XLRE was up over 1% today. So REITs had a good day here today, and were one of the only areas that actually even closed in the green alongside of utilities and industrials. Actually, I would throw healthcare in there as well, just barely getting into the green territory with a 0.1% increase. In terms of who the worst performer was today, as I eyeball this right here, it looks like it was communications, down 1.24% there. I know stocks like Netflix got hit today. Even Comcast got hit again today. Remember, we have that sold put on Comcast right now. I did see that Verizon raised their dividend today, so they managed to avoid the selling of the rest of the sector. But I saw Google as another example, that's in the communication space that was struggling here today. So that's an area that continues to be quite difficult for investors. But now we have that oversold cluster. Who knows? Maybe we get a little bit of a bounce here. Let's go ahead and now talk about our trade application example here for the day. And for it, I wanted to go back to a chart that we've already discussed a little bit. And in this case, we're going to take a look at chart 3A. And we're going to pull up ticker symbol TLT. This is the ETF that tracks the long bond for the U.S. Treasuries. So in other words, you're looking at durations of like 20 to 30 years are the types of bonds that they would purchase in the wrapper of TLT itself, right? You as somebody who trades TLT can, of course, get in and out whenever you want, but the bonds that they hold within the TLT are the 20-year, oftentimes into the 30-year category, so long-term U.S. Treasury bonds. And as you can see, we had an oversold cluster signal on TLT today as it did hit a new multi-month low. And it was down over 2% today. Remember, in the stock market, when I sell puts on individual stocks, oftentimes I would like to see the S&P 500 down over 1%. We didn't have the S&P 500 down over 1% today, but then again, we're trading sold puts on TLT here in this case, which really has nothing to do with the stock market, other than TLT can be somewhat of a proxy for what's going on with the NASDAQ stocks. I know that probably sounds peculiar, but you've heard us mention that earlier in the year as well, where interest rates are really what's driving whether the market is willing to take a gamble on tech stocks or not. And there's a lot of reasons that go into that, but basically it's the ability to discount future cash flows and at various rates. And when rates are too high in the short term, there's too high of a hurdle rate, and your price on the expected value of those tech stocks needs to come down as a result. But point is, if interest rates can go down, tech stocks stand a lot better chance of going up. And most of you know that interest rates and bond prices are inverse to one another. And so, in other words, TLT itself, which tracks bond prices, could be used as a proxy as to whether the NASDAQ and other tech stocks can go up. And right now, you can see obviously TLT has been going lower, lower, lower. And no surprise, the NASDAQ is in the midst of a 7-day sell-off right now. But if you think that that is overdue, whether it's because you believe this oversold cluster signal on TLT will provide a snapback rally, or if you just think the NASDAQ is due, right? It could mean one and the same, right? Here's QQQ, and you've got your oversold cluster signal right here. And if you think it's due for a bounce, it's another way of probably saying that TLT is due for a bounce. They kind of travel together in this current environment that we find ourselves in. Now, it's not just the daily cluster that caught my eye with TLT. Obviously, with the S&P 500 giving us a cluster today, I could have picked any number of individual stocks to sell puts on today if that was all I was looking for. In this case, the reason I selected TLT was partly because what I showed you there a moment ago with all those high treasury yields providing some sort of an important juncture for investors to start buying bonds because they're trying to lock down those higher yields. And there's multiple clusters going on right now for TLT. So this is the daily candle chart that I'm showing you right now. But let me switch the time period and use a weekly candle chart now. So let me pull up a 3-year weekly here. And notice that we also have the green dot showing up when we're using a weekly aggregation period. So notice up here it says W up there. Whereas before, let me go back for a second over to the daily, it says D up there for daily. both the daily and the weekly have oversold cluster signals. But wait, there's more. I kind of feel like one of those late night infomercials when I say that, but it's true, there is more. If I were to look at the 20-year monthly chart now, you can also see that as of right now, and again, it's early, so it could change by the end of September, but as of right now, early into the month of September, we also have an oversold monthly cluster. So up here it says M in the aggregation period. So whether you're looking at the daily, the weekly, or the monthly, TLT has an oversold cluster signal in all three of those aggregation periods. Now that doesn't guarantee that it's going to go flying back the opposite direction, but it can at least give you a general mindset that we are in some pretty rare territory of oversold here for a very liquid asset class. Remember, TLT is not just some sort of a new, up-and-coming flavor of the day SPAC company or something like that. This is a hugely liquid U.S. government bond market that we're talking about right here. So you'd like to think that they're due for some sort of a snapback rally. What I ended up doing, and let me go back now to the 3-month daily view here. Actually, I'm going to pull up a little bit further time frame because I wanted to point something out. How far back do I have to go? Maybe I do have to go back to the 3 years. Maybe it's even more than that. Let me try 5 years. Gee whiz. Maybe it's 10 years. Somewhere around here I noticed, yeah, it is actually 10 years. This is what I wanted to point out. So what I ended up doing here today, and remember, all of you who are premium members have access to the Telegram channel that David and I supply to our premium members. And remember, you can't find that. It's not in the public channel. So if you think you're following us on Telegram and you're a public member, you're not. We do have imposters on Telegram, by the way, as well. So we've heard that a couple of times, that somebody thinks that they're following us on Telegram, and in fact they're following one of our imposters, and they're trying to sell them these cryptocurrency schemes or something like that. Remember, David and I are not going to be doing that. So the way that it works for us is we will give you a private link once you become a premium member of Market Scholars, and that's the only way you can join our channel. You cannot find it if you're just globally trying to search it out there. But anyway, the trades are always done during the trading session and then telegrammed out to our premium members, so that way they can consider those trades for themselves before the market closes, whereas everybody else that just watches this free YouTube video can't place the trades if they desire until the following trading day. But anyway, what I did here today was I sold a October 101 put on TLT. And I did get more than 1% return on risk on that. I think it was something like $1.07 or something along those lines. And I know it was definitely over $1. And so, in other words, if the strike price is 101 and you got over $1 worth of credit, that means your break even is 99.80 or something along those lines, right? 99.90, somewhere below $100 per share. And as you can see here, when we're looking at a 10-year weekly chart on TLT, the lowest price it printed was way back here in 2013, a long time ago, 9 years ago. It did go as low as 101.17. So remember, my strike price that I sold was 101 even. But with the credit that I took in for selling that strike, my true break even is actually below the big round number of 100. So if it gets there, it would literally have to be the first time in 10 years that it got there, and it would have to do that during the life of my trade between now and the middle of October. Could it happen? Absolutely. There's enough negative pressure in the price here where that wouldn't be all that unbelievable to think about. But then again, it does go to show you again how extremely oversold we are right now with the daily, weekly, monthly clusters, and we would require a breakdown to 10-year lows in order for our trade to get in trouble. And I actually think that treasuries at $100 for TLT wouldn't be a bad investment. At some point, if you think we are about to go into a prolonged bear market in the stock market, you would like to think that TLT will stabilize. Right now, it's having a hard time because you're kind of betting against the Fed, right? The Fed keeps on giving you the impression they're going to keep on raising interest rates. But if we go into a true multi-year prolonged bear market in the stock market, there's a pretty decent chance that treasuries, the bonds themselves, will stabilize, because Jerome Powell will go from raising interest rates to eventually lowering them if the moment in time is chaotic enough. Now, I don't expect that this calendar year, but again, looking down the road, what you will find in all likelihood is that treasury bonds will be a go-to asset class if the sky is falling in the stock market at the time when Jerome Powell feels like he's got inflation under control. That could take some time, but just, thinking down the road a bit, that's what we usually see in market breakdowns in the past, is that treasury bonds do stabilize. So even if you were forced to take ownership of TLT with a cost basis just under $100, I think that could be a reasonable way to kind of try to preserve your capital if you do expect the stock market itself to be extremely bearish in coming years. Okay, so that was my trade application example for tonight. I hope you got value out of this presentation. A lot to go through here today as we kick off this holiday shortened week, but mostly it's clusters, 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 if there was a theme for today. Because not only do we have clusters across all four major U.S. equity indices, we also got it in the foreign markets, right, with EEM. We've also got it with U.S. government bonds. And so it's somewhat rare to have so many clusters in different asset classes like that. But that's kind of the sign of things, of where we stand right now in the market. So if you got value out of tonight's video, whether it was through the macro discussion or through this trade application example or anything else, I ask one simple request out of you. Please click like for me there on Twitter. I'll make the same deal with you I always do, which is if you can get up and over 100 likes on Twitter, I'll be happy to do another full-length video for you when it's my time to do the video on Thursday. If we're under 100 likes, then I'll just plan on doing a 15-minute version, and so it doesn't bother me either way, whatever you prefer. So don't do it for me, do it for you. If you prefer the longer format with more analysis, then click like, but otherwise, I'm happy to do the shorter length video as well. So we'll let all of you guys decide collectively what you want. But I do appreciate you checking out tonight's video regardless, and I'll look forward to seeing you all down the road. Take care, everybody. Bye-bye.